On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're all well. That's another week down and we've only got, I think, 11 trading days to go in 2025, so certainly at the business end of the year. Looking back on last week, global share markets were mixed. The S&P 500 in the US was down 0.6%. We saw investors rotating out of tech stocks and into other parts of the market, many of those value stocks or those areas that are perceived as being not as expensive were in vogue. So the communication services sector was down 3.2%. That's where the likes of Google and Meta reside. And the tech sector, which is where Nvidia, Microsoft, Apple and so forth reside, that was down 2.3% last week. They were the two worst performers on a sector basis. At the other end of the spectrum, we saw the materials sector up 2.4% and financials also found a bit of support. They were up 2.3%. The FTSE 100 in the UK slipped 0.2%. European shares were up slightly, so were emerging market equities. The Japanese Topics Index had a good week. It was up 1.8%, and the Australian ASX 200 added a solid 0.7%. The local market slipped back. It was down 0.6%. It's gone okay over the second half of the year, but that was still its fourth negative week out of the last five. A lot of movement in local interest rates. This has been a really interesting story. The New Zealand 5-year swap rate, and that's a wholesale rate, it rose another 24 basis points last week. It finished at 3.72%. Now that is the highest in more than 8 months. I think you've got to go back to late March to find a time when it was as high as that. And it's up 79 basis points. That's 0.79% since the lows of 8 weeks ago. So we've seen at least 3 lenders increase mortgage rates as a result, Westpac being the highest profile. They were the first to move. And when you look out to next year and you look at the RBNZ decisions that are coming up, when you look at that May 2026 meeting, markets are now pricing in a 40% chance of an OCR hike by May. So things have changed, haven't they? Looking back at some of the key events and releases from last week, and we had a couple of big central bank meetings that were worth watching. The biggest was the Federal Reserve, and the Fed reduced its policy rate by 0.25%, 25 basis points. That was expected, and that took the upper bound of the Fed funds rate to 3.75%. However, it was far from clear-cut. The committee voted, and the vote was 9-3 in favour of that cut. So we haven't seen 3 officials vote against a policy decision since 2019, and the dissents came at both ends of the spectrum. You had two Fed presidents that would have preferred to keep rates unchanged, and you had one person who dissented in favour of a bigger 50 basis point cut. So you've definitely got a divided Fed. Now that was the third cut of 2025, and when you look at the dot plot, which is their forecast pack, we got a fresh update on that too. The Fed sees one more reduction coming in 2026 and then another in 2027. Markets see a faster pace of easing. Markets see at least 2 cuts priced in for 2026. So I tend to agree with that. I just can't see the Fed only moving once next year. I think we'll get at least 2 cuts. There was some other news. It wasn't just the rate cut and the new forecast. The Fed also announced fresh purchases of short-term Treasury securities. It said it would start buying $40 billion US in Treasury bills this week, and it's doing that to maintain an ample supply of bank reserves. So they're not calling it QE. It's not quite QE. We're not back at those days again, but sort of similar, to be honest. We also had the RBA. They announced their latest decision earlier than the Fed. They left rates on hold, so there wasn't much riding on this one because everyone expected a no change, expected the RBA cash rate to stay at 3.6%, and this decision was unanimous, so no dissenters, everyone pretty happy to leave things as they are. The statement was interesting. On the one hand, the RBA said that some of the recent increase in inflation was temporary, and they also said that that monthly CPI that we've all been watching, that's the one that's pushed up to an 18-month high of 3.8%, they did point out that it was a relatively new one, and it is prone to being volatile. So I think they're kind of saying, look, that could easily unwind over the next few months because that series has been a bit up and down. It's that quarterly inflation report that I think they probably put a bit more weight on, so we'll have to wait till the next one of those comes out. At the same time, they cautioned that there were some signs of a more broadly based pickup in inflation, which may be a bit more persistent. So there really was something for everyone in that RBA statement. If you're on the dovish side, you can find something that supports your view. If you're on the hawkish side, then you can find something that supports your view as well. So I think next year will be a really interesting year for the Reserve Bank of Australia. So the last full trading week of 2025 is upon us, and it is shaping up as an incredibly busy one right across the world. So get a cup of coffee, get a cup of tea. This might take a while for me to go through everything that is going on. In the US, we will get delayed jobs and inflation reports. They will take centre stage, even though they're likely to be subject to data quality issues because of the shutdown. And we'll also see the US retail sales report for October. So there is a lot to watch in the US. I think the key things will be that jobs report and the inflation report. So the jobs report is out on Tuesday. Normally comes out on Friday. It's going to be on Tuesday. The CPI report is scheduled for Thursday. Now, the last jobs report that we saw was from back in September, and this one will be for November. So October sort of fell into no man's land. We should get some elements of that October report with this one, but it will be incomplete. So there's only going to be so much we find out from this report because it will be partially missing. In September, the unemployment rate was 4.4% in the US. That was the highest we've seen since late 2021. Markets see that as being steady in November, so we'll see if that moves or if it's unchanged. As for inflation, the headline inflation rate expected to push up a little bit to 3.1%, core inflation likely to be steady at 3%. So the Fed would obviously rather both of those be in the twos, but at 3 or 3.1, look, it's not the end of the world to be at those levels. There's also an awful lot going on in the central banking world. We'll get monetary policy decisions on Thursday from the European Central Bank, the Bank of England, and central banks out of Sweden and Norway, all on Thursday. Sweden, that's where our new central bank governor here in New Zealand has come from. So you'll get a lot of them on Thursday, and then we'll also hear from the Bank of Japan on Friday, and that will be a really interesting one. So what are we expecting from those big three, the ECB, the BOE, and the BOJ? No change is expected from the ECB. It's reduced its policy rate to 2%. Inflation has come down to 2.2 and it looks pretty stable, so I think they are probably done. The Bank of England, on the other hand, is expected to cut interest rates this week. We should get another 25 basis point cut. That would take the policy rate to 3.75%, so still above where we are here in New Zealand or where the Australians are, certainly above where the European Central Bank is. And then the most interesting one of all could be the BOJ, and this will be on Friday afternoon. Markets see a 90% likelihood of the first interest rate hike. Remember, we're talking about cuts in most other places, the first hike since January. And it would only be a 25 basis point move, and it would only take the policy rate to 0.75%. So still incredibly low compared to everywhere else. But get this, that would be the highest we've seen in Japan since 1995. So quite a lot going on over there, and it's worth watching. The 10-year bond In Japan, the 10-year JGB, Japanese government bond, that has increased in recent times to the highest level since 2007 on the back of this expectation that you will see another rate hike in Japan. So that will be really interesting too. Right, what else have we got going on? We've got Chinese activity indicators. They will kick things off on Monday afternoon. Retail sales, industrial production, fixed asset investment. Those are always useful to just help us keep our finger on the pulse of what's going on in the world's second biggest economy, China, and also New Zealand's biggest trading partner and Australia's biggest trading partner. So that will be interesting on Monday afternoon. On Tuesday, we'll get another set of really interesting activity indicators, the global flash PMIs, and these will cover the month of December, so they'll be really useful in terms of helping us gauge how the global economy is finishing the year. We'll get the Australian measure first up. That's out at 11 o'clock on Tuesday, NZ time. That will be followed by Japan at 1:30. Then we'll get the corresponding releases from the UK, Europe, and the US that evening and overnight. Now, last month's PMIs, November, were solid across the board. We saw all of those regions easily above the break-even level of 50. The US stood out. Again, its composite PMI was sitting at a very, very healthy 54.2, and the European equivalent, not quite as strong, but it still rose to 52.8, which is the highest we've seen in Europe in 2.5 years, so not too bad either. So that is the rest of the world, but I'm not finished because there is also a whole heap of stuff happening here in New Zealand. So we'll have a really busy week. So while you're all at Christmas parties and lunches and enjoying yourselves and winding down, there will be plenty going on for economists and market watchers. We'll have the HYEFU on Tuesday. We've got Thursday's GDP report. Those will be highlights. We've got the last dairy auction of the year. We've got the last housing market report of the year from the REINZ, and we will get a fresh ANZ Business Outlook survey. So some of those will be really worth watching. Things will kick off with the HYEFU, and that of course stands for Half-Year Economic and Fiscal Update, and that is out on Tuesday, I think at 1 o'clock. It's basically the government opening the books and telling us what sort of shape the country is in. Now, the economy has obviously been weaker than hoped this year, and I think that's likely to be reflected in the books and the Treasury's outlook. So that's on Tuesday, 1 p.m. The next day, Wednesday morning, early, we'll get a dairy auction. So this will be the last global dairy trade auction of this year. Things have obviously been pretty disappointing. A fortnight ago, we saw the biggest fall in 3 months. Prices have slipped for the last 8 auctions in a row, so we'll be looking for a bit of stability. Prices are down about 13.5% this calendar year, and coming off last season's record payout of $10.15, I think it was, we're now somewhere in the mid-9s. So not terrible, but certainly off the boil from where we were. So that is early on Wednesday morning. Also on Wednesday, we should get the latest Real Estate Institute report. I think this is due at 9 o'clock on Wednesday. This will be for the month of November. So we'll see how the housing market is looking as we head into summer. Lately, we've seen a bit of evidence that things are improving. In October, sales volumes rose, the days to sell slipped, and prices pushed a little bit higher too. So we've seen 3 consecutive monthly gains, and they've only been small, but that's still the strongest period we've seen since late last year. So things do look to be improving slightly across New Zealand for the housing market. On Thursday, we'll get what is probably the highlight of the week, the September quarter gross domestic product report. So this should take centre stage, I think. It's out at 10:45 a.m. on Thursday, and markets are hoping that we will get some more good news to end the year. Now, we've had a string of quite subdued GDP reports, a lot down, a few up, but only up modestly, so it's been a pretty tough period over this last year or 3. But the Reserve Bank is forecasting a quarterly increase of 0.4%, which will be solid. But since those forecasts came out, we've seen retail sales come in better than expected, building volumes, manufacturing figures also better than expected. So economists are now expecting somewhere in that 0.8, 0.9 range, which would be pretty good. We'll also be watching the revisions because you could see some of those previous releases updated. So Stats NZ might come out and say, well, that June quarter that looks so bad, well, it wasn't nearly as bad as that. So we'll wait and see, because there is some clear evidence that the economy has passed its weakest point and that it's turning a corner now. So this will be interesting to watch, and we'll be watching things like interest rates, things like the New Zealand dollar, which have been moving higher in recent times, and those expectations about what the Reserve Bank will do next and when. I'm not done though. We will also have another ANZ Business Outlook survey. This will be out on Friday, late in the week. If any of you are still around, 1 o'clock on Friday afternoon. We'll be hoping that it points to businesses ending the year on a fairly positive note. Now, in November, business confidence surged to an 11-year high, and we saw own activity jump as well. We saw past own activity increase to the highest since 2021. So all looking very good, and it does tell us quite firmly that the mood has improved and is getting better. So we'll be looking for that optimism to continue, and we'll be looking for some indicators that businesses are going into next year feeling very good about what the future will bring. So that is us. I know it's a really busy one. A couple of things to watch on the corporate front too. A few AGMs here in New Zealand. Comvita, Napier Port, Sanford all holding AGMs. ANZ Bank across the Tasman. That'll be an interesting one. Might get a trading update. And a few companies to watch internationally as well. Most notably for me, FedEx and Nike, which are both reporting on Thursday. So that will be Friday New Zealand time that we will see those results. So that's it, team. We're nearly there. This is the last of the regular programming. No more week ahead podcast episodes or reports until sometime in January. But there will be, I'm sure, things that spring to mind that I want to jump on here and talk to you about. So much appreciated. Hope these have been useful. If you've got any ideas about things you want to hear about, things you want me to talk about, anything different or more that you want as we work on the content plan for next year, then just hit me up. I'm pretty easy to find. LinkedIn's probably the best place, so just drop me a message. Never on WhatsApp. If you ever see me on WhatsApp, then that's probably a scam. I know those are still going around, so please don't fall for any of those dodgy pump and dump schemes that you're seeing on WhatsApp. All right, all. Enjoy Christmas, enjoy your holidays, take care, stay safe, and we will talk again soon.
For more insights, visit craigsip.com.